Okay, good afternoon, everybody. Today's Friday, May 20th. It's almost 2 o'clock Pacific time. Market's been closed for 40 some minutes here. This is your weekly take on the market. I will be your host again, no surprise. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at IBD. Take a moment to read the disclaimer. We're not licensed at IBD. No one here is. We don't make buy, sell, hold recommendations, provide research, education. Ideally, we want to teach you guys how to fish on your own, so to speak. Okay, so markets, industry groups, stocks, quote of the week, right? Same as always, same bat channel every week, same time. Let's talk about the markets because that's where all the action is for sure. So I found it very interesting today that the S&P, and let's pull up the markets, bear with me here. So let's go to the S&P. I think today, well, I know today the S&P made the bear market low that everyone was looking for, because I got a little pop-up on a news app that said S&P is in a bear market. And then by the end of the day, I guess the S&P was no longer in a bear market. I don't know how they measure it, high to low, closes. It's not really neither here nor there, right? The 20% is arbitrary. There's nothing magical about 20%. But I found it a bit interesting, though, that we've been screaming from the rooftops that this has been a bear market, and I've believed it's been a bear market for a lot longer than most people have said, right or wrong. I'm not trying to be right, I'm just telling you how I see it. I just want to make money, to be honest with you. Sometimes being right and making money aren't one and the same. So I'm just trying to stay in tune with the market. I think the market's been a lot weaker than the indexes have shown. And if you watch these videos for any number of sessions, you've heard that from me a million times. But I found it interesting that, now it's officially a bear market. So buy the rumor, sell the news, or in this case, sell the rumor of a bear market and buy the news. You got like a little rally today in the S&P. It's just day one, and we did undercut the low. So I don't know what IBD is going to do. I'm not on the team. I don't make those decisions. I don't know if they're going to go to correction because we made a new low, or, I don't know if they have the flexibility. How I would handle it is I would just wait. If you've called this already, I would just stay in market in upturn under pressure. But I don't know. I don't know what their rules are. Remember, it's rules based on the book. So if we undercut the low, they might be forced to go to market in correction based on the rules they've been given, and then wait for another follow through day. So I'm going to be flexible. I'm not subject to those rules. And so I'm thinking I would say the market's very neutral here. It's a really bad bear market. Stocks have a really hard time going up, but that's become more and more obvious. And so you got today a non-confirmation finally in the market. So you had the S&P made a new low. You had the NASDAQ make a new low, and 0RUS, although it might not update. We can use IWM. Let's use IWM. And you can see that the Russell did not make a new low. So, it's the Russell. So it's not the best of indexes. I think perfectly would be like the S&P makes a new low, but the NASDAQ doesn't, right? If I could set it up exactly how I wanted. But I'm getting non-confirmation here. And the fund that's led the market down has not made a new low in 2, 4, 6, 7 days here. So ARK as well did not make a new low. And this has been the poster child. Well, it was the poster child for the bull market and the poster child for the bear market, right? Number one ETF on the way up. I don't know the rankings, but I'm going to guess number one ETF as far as diversified ETF on the way down. So if you go to the 60-minute, you can see like it's really trying to hold up here. This is a 60-minute chart, for what it's worth. But so you're getting a little bit of non-confirmation, which if you're short, I would be heeding those signals that maybe it's long in the tooth to the downside. Depending on how aggressive you want to be, do you want to go long on these types of signals? I don't know. Most of you are probably better off waiting for another follow through day and setups, something to buy, a cup with handle, a double bottom, a flat base, something like that. Or worst case, something coming off the moving average that you've liked for a while. Yeah, and ideally a longer term moving average, like a 10-week or 50-day. So you had a little bit of non-confirmation today. Let's see what happens. As far as, does it lead to anything? So you undercut the low, didn't close there. The S&P undercut the low, actually closed blue. I don't watch the Dow too much. Let's see what that did. Very similar to the NASDAQ, undercut the low. And so that's pretty much the overall markets. This is a chart from Refinitiv Data Stream, and you can see the average duration of a bear market. So I feel like we've had enough damage to be, a classic bear market, maybe even one of the worst bear markets, like 2000 style, 2008 style. This is fit that mold to me, because of the damage in the PayPals and Shopify's and Nvidias and Zooms of the world. But duration wise, you can see it's just a baby. So it's very, very small, but there's not that many data points. And so it doesn't have to be as long as 2002, that bear market, or 2007 to 9. The market's more dynamic nowadays. I feel like the information is absorbed so much quicker. So it's not unusual, I think, for it to be so shallow as far as duration. The 2020 was an outlier because of the COVID crisis and the response from the government and the Fed just flooding the markets with money. This might be somewhere in between, and I don't know how they're measuring. Is this, oh, here we go, from peak to trough, which is important, so we could make a low and then literally go sideways for weeks and months before there's buyable stuff. That seems likely to me, because a lot of stocks are so damaged. It's going to take weeks for them to build bases. So that maybe we do get some type of duration. So damage wise, really bad bear market. Duration wise, middle of the road. This is an interesting chart from Hedgeye Risk Management. I found in a tweet that the short interest of Tesla. I really like this chart. I wish we had this in MarketSmith. Food for thought. It's something like, if I could have my way, I'd love to be able to graph this. There's nobody short these names anymore. This is not shorting that's causing these stocks to go down. Okay. In fact, you can see the shorts have been reducing their exposure the whole way down in something like Tesla. And I'm guessing a lot of the other high beta, high short interest stocks probably look very similar. So it's not that they're pushing these stocks down. It's a liquidity drive. Some hedge funds that closed. There's some hedge funds that are down 40, 50% that are probably going to have to close their doors. And they're loaded up in these stocks like Facebook and Netflix and Apple and Google and Tesla, and they need to raise money. And the place you can raise money is in the stuff that's really liquid, really big. And so, they tend to sell what they can, not what they want to. And so Tesla, Apple, these are stocks you can sell. You can, Microsoft, they can create liquidity. So Tesla's gone down because of that factor, mostly, I'm guessing. I don't know. It doesn't really matter like the why, but what this chart indicates to me and tells me in my feeling about it for a while, because I have been and am short Tesla. Although honestly, I don't know. Today was the first day this year that I really felt like maybe I should cover my short. Maybe I should step aside. But I've been pretty patient with it, and so today I really fought that urge. In fact, I did reduce the position pretty good, just because I hate to get that feeling that I should do something, not do it, and then if it's right, it'll bother me. So if I reduce and I'm wrong and it keeps going down, that's fine too. It doesn't, at least I have a little bit. But so the shorts have been reducing on the way down. They're not driving this stock lower. All right, let's get into the industry groups. Industry groups, and honestly, I have to admit I haven't looked at it in the last 3 or 4 days, but I'm going to guess it's going to look exactly like it's looked for weeks and weeks. Energy coal is 1. Drilling is 2. Interesting. Went from 5 to 2. That's interesting. I'll have to look at a stock in that group. Royalty Trust, International. Wow, look at all of this. So it's just stacked with oil and gas, and they're not really rallying anymore. There's a lot of weight on the market. So I found I do own some oil and gas related stocks, and they're not going up. They're going down less than the market, which is good, I guess. But it's you have to wonder how long that's going to last for. So, but this is the best group, and until you see otherwise, that's where you should do your fishing if you want to participate. Anything else in here that really jumps out at me? Machinery equipment moved up a little bit. Yeah, it's kind of the same thing. So I guess the only thing that is oil and gas drilling. Like I'll probably look to see if those are setting up like VAL. It just jumps to mind for me. So this is a stock that, same old story. I was buying down there. Actually, even better than that, undercut. It was a reorg. Nobody wants to own oil, and the chart is telling me it should be bought. Those are my favorite setups. Just got, I did okay in it, and I moved on, but it looks like it's setting up an ascending base. Interesting. Let's see what the weekly looks like. There's another one that looks another reorg. These companies were in such dire straits that they had to do reorgs just to stay alive. So it's kind of clean sweep broom in that regard. It allows them to reduce all their debt or renegotiate the debt. It's better to get 10 cents on the dollar than nothing, or 50 cents on the dollar than nothing. So sometimes it allows these, and then the whole macro picture changed as well. What was the other one that I owned? Because I sworn it started with a W, but maybe it wasn't exactly a driller. So this interesting. Drilling is holding up. Let's look at, since we talked about it, we'll look at Tesla. Now, now I think it's breaking the lows. This will probably turn off. In fact, let's see how far off the highs it is. 46%. Yeah. So it's going to lose this base because it's going to be more than 50% off the highs. So, if you're bullish Tesla, great. Wait for a base. And the good news is, I don't know if it's going to undercut this low. My gut is yes, eventually. Maybe not on this wave down. Maybe there's something like that. But if not, you've had some pretty good damage, and you're waiting for a new base, and you'll have another chance. But it looks pretty damaged. Apple, 1, 2, this is 2, 4, 6, 8 weeks in a row down. I was looking, I couldn't find where Apple went down 8 weeks in a row. This is the closest it got. So you have 2, 4, 6, 8, 10 weeks, but there is a blue week in there. It's kind of, but you get the same kind of feel. This went down 40%. Right now we're at 25. So food for thought as far as Apple. It's a place, it's overowned, store of liquidity. If you need to raise capital, it's easy to do an Apple because it's, you know, so big, but not acting well at all. Let's go back market wise, because there was one thing I wanted to talk about. It's the interest rates. 0TNX is the, you know, the 10-year notes. It's the interest rate. So that's, you know, 3.167 or you know, is the rate. This is kind of the opposite of the bond. But you know, if you're curious, like if it's killing you on like what's happened to the market and kind of the why, I guess, you know, this is probably the most obvious why ever. This is a huge move, right? Just this year, it's doubled, and you can't even see. Let me go to the monthly, but you know, 4 to 30 is just incredible. So the pressure that the interest rate, the bond market has created is really what's they're putting all that pressure on stock prices. So I watch the bonds because I would like to see them kind of hold up. And if they can just kind of breathe a sigh of relief, maybe they're going higher, but you can see like in 2018 when Powell was trying to raise rates, it got to this area. This is like the Christmas Eve massacre, if you remember, was somewhere in here. And then, you know, they call that the Powell pivot, you know, right into COVID. Now, this is a fugazi. This is fake. Okay, this is related to the whole COVID move and all that. So I think you can kind of just think of this as just like an outlier. But you know, you look back, you can see how this rate has been in this kind of area for a long time. So if it goes above that, that's probably going to put a lot more pressure on the on stocks. This is the 5-year note. And so look at that move from 2 to 30. So, you know, I know it's went from, you know, really low, but you know, that's a big move, 15-fold move off the lows from, you know, from crazy move. If you want to even just consider it from here, it's a triple. So that's where all this pressure has come from. And so we really, if you're a bull on the market or prefer to be a bull, and we all do, because it's just easier to be a bull than a bear. You know, we need rates to stop, you know, kind of, you know, they don't have to go back down. They don't have to go back down. Let me show you. In 1995, well, I started in late 94, and I remember there was a bond bear market. I didn't know what that meant, but I remember there was a bond bear market, and stocks I was buying were not working. They were going down. So somewhere in this little bond bear market was, you know, was the problem. And then, you know, then it rallied. Then you had a, this is like the Asian crisis right here. And then you had a rally, and you can see how, you know, lower and lower rates, but, you know, the market's done super well with rates above, you know, this number. So this 98 to 2000, really good bull market. 2003 to 2008, really good bull market. You can see most of that time, the 5-year was higher nominally than where we are now. So, you know, the stock market can survive at 5% interest rates, I hope, you know, unless inflation's 8%. A whole nother story, way above my pay grade, but it's in the back of my mind, that type of thing. So I would like to see this just kind of slow down. And you see on the weekly or the daily, at least for now, it's stopped making new highs over and over. So maybe we have a chance. You know, TLT is a proxy, and you know, it's gotten hit really hard. This has been one of those years where I have friends that, you know, like, what's going on in the stock market, you know, because they're in their 401k or whatever. And I have a friend who's, I think I asked him, I said, how old are you? Why are you still in the stock market? Because he's retired fireman. He's 62. And I said, well, you probably shouldn't be fully in the stock market. He says, I'm not. I said, but honestly, if you had been 50-50 stock market and bonds, your performance probably would be the same because the bond market's done so poorly. It's such a terrible year. So this has been a really tough year to be, whether it's asset allocator or buy and hold or any of that. This has been a perfect storm, an unfortunately perfect storm. All right. Are there any other stocks I wanted to talk about? I wrote them down here. So, and how long have I been going on? So just thinking out loud, like going forward, I wanted to look at like Team, which went public in 2015 and then went down and then, righted itself. So you can see it went public and then broke, 50%, and then slowly but surely eventually built a base, which sort of worked, and then built another one, which worked really good. So, there's some stocks out there that are trying to make lows. I talked about like GTLB and DLO and all these things. But I think after studying them, just way too early to try to get involved. I'm better off waiting for this. So if they're really going to be great companies and come back, they will do this. They will build a base somewhere along the line. If we go to Twilio, you can see really, really good. And then just cratered from 58 down to 23, more than half, but then you get a base breakout. Admittedly, not a great base, but at least you have some type of pivot if you like the company. So I think you want to wait. If you're down there, you've got like a list of names of companies that are really appealing to you. I just think you want to wait for a base based on history. Yeah, you might get obviously the best price for Twilio was here or here or here. But the right price was there because, and I'm just speaking for myself. If I bought the exact low in Twilio, I never would have survived that. No way. Now I might have sold it for a little bit of profit, but how am I going to capture the really big win? So there's a best price and there's a right price. And that's the right price. After that huge week, it just kind of sits there, kind of like research in motion after it. Although this is not a new 52-week high, but you can see his stock goes up 35% in a week, and then the following week just sits there. Short stroke is what they would call that. Very, very rare, but you get the kind of the idea. Other food for thought is why we cut losses. Walmart, worst day since 1987. Target, kind of, same thing. And these are earnings related gaps, right? So another thing is you really want to know when the companies you own are going to report, and know that anything can happen, that there's an exogenous event that can create, it can go both ways too. But if you're in a bear market and you're holding stocks through earnings, you really have to know that you're swimming upstream. And I would have never guessed in a million years that Walmart would have its worst day since the 1987 crash right there. So going into the earnings, it wouldn't even be on my bingo card, right? But we are in a bear market, so you have to know that it could be bad, it could be down. And so, either avoid that or build it into your model as far as position sizing, because that's pretty devastating. Now, other thing is, if you're in it and it gaps down, what do you do? And I really believe you start selling, you get in motion. So if you have 1,000 shares and you just can't stand to sell it because you're afraid it'll come back, sell 100, sell 200, sell 300, do something and get in motion. Because once you sell 100 or 200 or 300 or 500, you'll start to feel better if it's that you got out of some, and it'll make it easier to start getting out of more and just getting out of it. Because if you sold it at 138 on the open, now it's 135, 134. you won't be so frozen. This is from personal experience. And if you're wrong, if the open is the low, which that can happen, it's happened to me before. I sold a stock that was gapping down, and by the end of the day it was up, but I didn't sell all of it, so I still had some. So that's frustrating too. But I think in the end, when they gap down like this, the probabilities are way skewed that they're going to keep going down. So get in motion, protect yourself is really the thought process. All right, the quote of the week: successful investment is a blend of standing your own ground and listening to the markets. Anthony Bolton was a portfolio manager with Fidelity in the UK. They sometimes have heard him referred to as the Peter Lynch of the UK market. He had a really great track record, 20% for years and years running a fund. And so, you have to have conviction. You have to have certain ideas that you like to be able to stay with it. You got to have a system that you believe in. So there's some of it is very personal, but you also have to learn to listen to the market, know what the market is telling you. So I sometimes I think stocks are going a certain place, up or down, but if the market's telling me otherwise, I have to recognize that. Especially if it continues to tell me otherwise. So hopefully you guys are doing okay. It's just crazy, interesting market. Next week probably be super interesting. I'm curious if we can get any kind of a rally for even a day or two. Because the thing about this market, it's very, very heavy. Here's the contact information: marcusmith@investors.com, 800-831-2525. Have a great week. I think next week, I'll be back. Next week I'll be back. It'll be the following one where we'll have the monthly Marcus Smith webinar. Take care, everyone. Have a great weekend. Bye-bye.